Welcome back to Successful Living. I'm joined by Steve Tetzner from Homestar Mortgage. Steve, welcome back to the studio.
Thank you. Great to be back.
Good. It always seemed like over the last, I don't know how many years, we kept talking about rates going down. And it sounds like we might have something to talk about going in the other direction today. What are the rates like? We'll kind of start there with our basic update, and I think we have a graph if that's helpful.
Yeah, I think graph would be great. So we've seen a significant spike in mortgage interest rates, specifically in the last 60 days. You can see on the graph where, over the last year, the rates have been inching up, very moderately. The peak low in the 30-year was down around 2.5. It started approaching around that 3% mark, but it moved up there very, very slowly. Then all of a sudden in January to now, in the last 60 days, we've seen rates move up in the 3/4 to almost full percentage point.
Yeah, so that graph, it's pretty flat, and like you're just saying, right when it peaks is what, January?
Correct.
Not peaks where it starts.
Yep, you can see that very sharp increase, which is basically starting at the beginning of January and going into the end of February. So we've seen a significant increase where the 30-year mortgage rates basically went from just under 3 to just under 4 within a 60-day period.
Wow. And I think, some people think, I'm not sure how people view this, but 1% is a lot.
It's significant. I mean,
Yeah.
If you're a first-time home buyer or, you're on a budget and, that can, significantly affect how much house you can afford to buy. So now as a buyer, you're in a perfect storm where housing prices are going up very significantly and mortgage rates are going up. So your buying power, especially as a first-time home buyer, is going down. It's some people are just getting priced out of the market.
Okay. Would you say that's kind of going across the board where the rates have increased from the 30, the 20, the 15?
They always follow each other. Yeah. So
okay.
Typically a 30-year mortgage rate, let's say it's at 3.875 approximately right now. The 20-year rates are usually 1/4% better, so you'd be about 3.625, and a 15-year rate is usually 3/4% better, so you'd be down around 3.125, and that's consistent with the market. All rates are going to move consistently at the same pace.
Okay, all right. I'm not sure if you can tell us this. If there's one thing, a few things, what's contributing to this spike, in January of this year to now?
The economic conditions. I mean, one of the biggest factors right now is the inflation. As we've talked about over the years, the worst enemy of mortgage rates is inflation. And with the spikes in inflation that we've seen in the last 60 days, that's really the biggest contributing factor to the spike in mortgage rates.
Okay, and a lot of people might ask this, and I'm sure it's indirect, but with Russia and Ukraine being at war, is that another piece of that? Does that somehow indirectly kind of cut into that because that's affecting all markets?
It does. So that actually makes rates go down a little bit.
Oh, okay.
So, when Russia invaded in the last few days from when we're taping, the mortgage rates came back down an eighth, almost 1/4%. But the market will adjust back to that very quickly. That's a very temporary blip. But any negative news, whether it's world news or economic news, is a positive for mortgage rates. Mortgage rates go down. Positive economic news, mortgage rates go up.
Okay, all right. One of the things we talked about, and we were talking about, hey, what do we want to kind of talk about in this show to help people out, was buying a vacation home and how that landscape has changed drastically in the short-term past right now. Can you tell our viewers a little bit about that and what's changed and how that's going to affect them if they're thinking of purchasing a vacation home? Yeah,
so there's been a significant policy change with Fannie Mae and Freddie Mac, which has trickled into all mortgage markets. In the past, if someone was buying a vacation home, house down at the beach or on the Cape or Narragansett Shore, the interest rate that someone would be able to get if it was a vacation home, not a rental home, would be the same as if it was their primary residence. So the interest rates were very attractive, and it made that market very strong. Just recently, effective not more than a few weeks ago, Fannie Mae and Freddie Mac has implemented a change in those rates. So depending on the down payment on the vacation home, the rates are similar now to what you would pay as if you were buying a rental property or investment property. So if you're putting 20% down, for example, you're going to pay 1% over what the interest rate is on an owner-occupied.
Really?
If you're putting 25% down, you're going to pay about 0.5% higher.
So it's actually pretty drastic. If rates have popped just in the last 2 months 1%, and now you're adding another 1%, you're talking about, hey, I was thinking of buying a vacation home. I'm now paying 2 points.
2% higher, correct. Yeah.
Wow.
So that's definitely, I think, going to impact people's decision in that market.
Yeah. Okay, so does that vary state by state, or that's national, right?
That's national, yeah.
Okay.
Whenever you talk about a policy with Fannie Mae or Freddie Mac, that's a national policy. So that's going to be any lender anywhere in the country.
Okay, and that's up to change? That could change in the future, and is there a duration where it says it's absolutely going to be like this for a specified period of time, or can it change?
Policies always change.
Okay.
I've been in the mortgage business now for almost 27 years, and I've never seen this policy. So, you know, policies change for the better and for the worse. So, you know, I think that, you know, if we see some different political landscape in the future, I think that we could potentially see that repealed or even possibly reduced a bit.
Okay. Has this ever happened before? Like
No.
before even the 20 years that you're talking about historically has never happened?
Not in this particular
And that's to
time.
obviously generate what? More?
Well, normally Fannie Mae and Freddie Mac apply risk basis to the interest rate. So, you know, if you have a higher down payment and a higher FICO score, you get a better rate than somebody with a lower down payment and a lower FICO score. So it's all risk-based. I don't see any data that supports this significant increase in second home rates. So I don't know that this will be a permanent.
Okay.
You know, during the refinance boom, the government allowed Fannie Mae and Freddie Mac to implement an adverse market fee, where on refinances they were charging a higher interest rate than somebody buying a home. That's been repealed.
Okay.
So
it's ever changing. It's not.
who knows?
Okay.
Yeah.
Gotcha.
It's
Okay.
hard to predict.
Other areas when purchasing property have changed recently. We had talked about the condominium market. I think that was pretty significant. Can you tell us a little bit more about what that is and why it's changed?
Sure. So Fannie Mae and Freddie Mac are doing a little bit more due diligence in financing projects and properties that are within condominium associations. It's directly related to what happened down in Miami with the collapse of that condominium project, where they knew there was a problem, they weren't addressing the problem, and then people lost their lives.
Yeah.
So now Fannie and Freddie have implemented new procedures for lenders where we have to do due diligence to make sure that the property, the condominium building, is structurally sound and that there's no significant deferred maintenance that would affect safety or health hazards within the property. So it's a little bit of extra work. There's different tools that they've supplied us with to give us guidance on how to do that.
Who does the work? Is it
It's
you?
the lender.
It's the
Yeah.
lender.
Yeah,
So
it's our
it's not
responsibility.
someone. It's not the purchaser. It's the lender.
Well, it's our responsibility to acquire the information,
Okay.
And get the data from the condominium association, which we did in the past. But now this level of information is just something totally new.
Okay. And this is to protect it from, you know, falling walls, not good infrastructure, and just the safety of what you're purchasing.
Yeah,
Correct.
I mean, that's exactly correct. For example, I had a condominium project in Providence where during the minutes of the meeting, the condominium association was discussing a structural issue with a rear staircase. So we had to provide documentation to prove that that had been fixed prior to being able to close on the loan.
Any people not mention it now in the notes? I mean, I
They
know
don't
that's
know,
not.
they don't know yet.
I know that's not ethical, but I'm just saying. I mean,
Yeah.
sometimes you would be like, you know, if we put that in and we're looking for buyers. You know,
So what we do now is, unless there's an engineer study that's been conducted in the project within the last 5 years, we collect 6 months worth of the minutes from the condominium association and the management.
So it's not just a couple weeks ago
No,
or the last
no.
meeting.
We look at 6 months, and then if we see any discussion in there about structural or deficiencies, then we have to investigate to make sure they've been fixed.
Okay. You know, we talk about these changes that kind of happen, and I don't want to say they just pop up. I'm sure they've talked about it. Is there anything right now that's on the horizon that, you know, if we have someone that's thinking of purchasing a home or refinancing that's coming out that has just been talked about, or anything new kind of on the horizon?
There's nothing new that I know of. I'm sure there may be things that, you know, are above my pay grade that could be discussed that I don't know about yet. But we usually get some type of a warning. So, you know, this implementation of the higher interest rates with the second homes, we got about a 60-day warning that that was going to happen. So we were able to help the people that were in the situation where they were in the middle of shopping or purchasing, to notify them that, look, you've got about 30 days to make a decision, or you're going to be subject to this increase.
Yeah.
So usually increases like this or changes, they give us time to implement them. But I don't know of anything right now. The only thing that I can predict is I can predict higher interest rates as we go through this year.
Okay.
I'm confident that we're going to see the interest rates go over 4% by the end of 2022.
So that's exactly what I was going to ask you. I said, if someone's hesitant to say I'm going to refinance or purchase a home because interest rates have, you know, gone up, I would say, like, Steve, what would you say to that? And
pull the trigger now because the interest rates will be higher in the future. I mean, we've got a temporary lull because of the Ukrainian war, or the war in Ukraine rather, but interest rates, if you look at the normal market conditions, they're going to keep going up. You know, if we keep seeing these strong inflation numbers, they're going to go up faster than people expect.
Okay. I mean, can you tell us a little bit historically, when's the last time we hit the rate we're at now?
A little over 2 years ago. Yeah.
Oh, okay. So it's not
pre-COVID.
Okay.
Yeah. Pre-COVID mortgage rates were in the low 4% range. So it's a little over 2 years ago where we saw these rates.
Okay.
So I mean, and historically, you know, people like your parents, my parents, that paid 17% adjustable rate mortgages back in the 70s and 80s, 4% to them still seems great, and it's still a great interest rate. Don't get me wrong, but people got spoiled when interest rates were in the 2s.
Okay. All right. And people that are coming to you right now, what's the most common lending, I guess, activity that you're seeing? Is it still straight refinances, purchases?
It's purchases. The refinance market is pretty much dried up. People have either done it, or the interest rates now with the increase, it doesn't really make sense for many people to do it. So we're seeing very, very small percentage of refinance. It's predominantly people buying properties at this point.
Okay. As always, I mean, great information.
Thanks.
Appreciate you being here. I mean, this is good information to our viewers. When we return, we're going to talk about investment fees and how that affects your performance. Stay tuned.